All right, it's 12 o'clock. Hello, my name is Allison Dutcher and I'm with Elevations Credit Union, and I'm happy to introduce Aaron Staufer, who will be teaching today. Aaron has been in the real estate industry. Well, he started in the industry in 2006, then he pivoted into mortgage in 2009, and he then became a sales manager for one of our teams in 2020. And he is consistently ranked nationally as one of the top loan officers. So he is full of information. He loves to teach. This presentation will be recorded, and we will send it to you in about 24 hours after. And we will also be sending the PowerPoint. And Aaron always loves when our members ask questions. So please ask as many questions as possible, and he will answer them throughout the webinar. So thanks so much. And Aaron, I'll let you take it away.
Beautiful. Thank you so much, Allison. Alrighty, so a little bit about me before I get into everything else. And it's a lot of information that we're going to be discussing today. So strap in, get caffeinated. It's going to be, lots of information that I'm going to be doling out here. So as Allison said, I've been in the mortgage industry since 2009. I was in real estate prior to that. Actually, I had my real estate license in 2008. Prior to that, I was doing a lot of administrative assistant work, marketing, that kind of thing. But got my real estate license in 2008, which was the single worst time ever to get your mortgage or your real estate license. I sold two homes in the course of about 12 months. One sold for like $26,000. The other one sold for like $72,000. There were these little small condos behind an auto dealership. I was basically just doing anything I could to keep the lights on. And I was actually about to shift industries, careers entirely, and then I actually got recruited into lending. And that was a much better fit for me. I enjoy the technical sales aspect of it, heavy on the technical side. That's kind of my favorite part. I love the education side of all of this. So if you have a question, I'll have an answer. Allison will kind of aggregate the questions, and then she'll come back on screen. We'll field a couple questions and then keep going on. When I'm not coaching other loan officers or originating my loans on my own self, which I do, I originate loans for our members. I love to play soccer. I love to do yoga. My favorite thing right now is that I bought a motorcycle with a sidecar at the very beginning of the pandemic. It feels like a lot of things kind of moved up. Some things moved back with the pandemic, but one thing that moved up for me was I decided to buy a motorcycle with a sidecar, and I take my Irish setter for a ride. So if you ever see an Irish setter in a sidecar, that is Prince Finian and myself cruising around town. He took to it so quickly. He absolutely loves it. If I ever take the motorcycle to work or anything like that without him, he gets really upset. It's kind of sad. It's a little bit about me. So here's what we're going to be talking about today. We're going to be talking about various mortgage options. What are the different types of loans? How do each come into play? We're going to be talking about what a lender takes into consideration when we look to get you pre-approved for a mortgage ultimately. When we get you pre-approved, what does the lender actually look at? What's the pre-approval process entail? What is the home buying process? So we're actually going to be talking about from, again, kind of getting your home search to closing itself. What does that entire process look like? What do you need to be aware of? What are some things to keep in mind? Really kind of covering everything you might want to know with regards to the entire process. So let's start with mortgage options. Okay, so there's ultimately three different buckets that mortgages fall into. There's conventional mortgages. Those are backed by Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac are government-sponsored enterprises, okay? So they used to be completely independent, and then when the housing bubble popped, they basically came under the umbrella of the government. Fannie Mae, Freddie Mac are government-sponsored enterprises, what lenders will call GSEs, okay? Whenever a lender talks about conventional financing, they're talking about Fannie Mae and Freddie Mac loans. Fannie Mae and Freddie Mac are, for lack of a better term, the gold standard for mortgages. They are the best option. You could think about this as Plan A, conventional, Plan B being government, and then Plan C being a portfolio loan of some sort. Plan A loans are conventional financing. Prior to Fannie Mae and Freddie Mac coming around, there was no 30-year fixed mortgage. That simply did not exist. It was because of Fannie Mae and Freddie Mac that they had that secondary market established for mortgages, and that they started to come out with this 30-year fixed. 30-year fixed mortgages simply did not exist prior to Fannie Mae and Freddie Mac coming into existence. Second type of loan is your government loans. So unlike conventional are backed by the government, supported by the government, they're sponsored enterprises of the government, but it's not actually Uncle Sam, okay? Government loans are truly Uncle Sam, okay? FHA, Federal Housing Administration, USDA, US Department of Agriculture, VA, Veterans Affairs, they are truly Uncle Sam's actual money. Now, the government doesn't love being in the lending business, if I'm being real honest. If you ask them today, hey, like, should, the government be doing first mortgages? They'd say, maybe, so we can make sure that everybody's getting a fair shot at it, but we prefer not to be doing financing if we can avoid it. So because of that, they tend to have higher costs associated. They have oftentimes more expensive insurance costs, usually more expensive upfront costs, more difficult to get government loans. There's a lot more requirements with regards to the property that you're buying when it comes to a government loan. So that's why we call it a plan B. Conventional loans, as a first-time home buyer, you can put as little as 3% down. Government loan for FHA, you need 3.5% down. So larger down payment, more expensive, more upfront costs, usually higher monthly costs as well. So government loans do tend to be kind of a plan B. We go with plan A if we can. And then third option would be what we call portfolio loan. Anytime you've gotten a car loan, that is a type of portfolio loan. It is the bank or credit union's own personal money that they're lending out, okay? Credit cards are a type of portfolio loan. Personal loans are a type of portfolio loan. Car loans. And then some mortgages are also a type of portfolio loan. So plan A, plan B, plan C. And the reason I call portfolio loans plan C is because banks and credit unions are very quick to lend out the government's money, plan A and B. They're a little bit slower to lend out their own, okay? And I'll be talking about some of the ins and outs of that, but we're gonna be talking primarily about plan A, okay? Let's talk about plan A. So with plan A, you're gonna need to have around a 680 credit score. Plan B, FHA, USDA, VA, they'll oftentimes go down to a 620, sometimes as far down as a 500 credit score. Usually when we end up with a credit score in the 500s, there's stuff going on that might prohibit you from getting financing all in all entirely, despite your credit score being above that threshold. So conventional 680 or above, the vast majority of borrowers are going to fit into this category, which again is why we're going to be spending most of our time talking about this. Now, within each of these three different buckets, there's different types of loans. Okay, so there's different loan terms, there's different types of loans. Fixed rate mortgages are the most common, right? 30-year fixed, 20-year fixed, 15-year fixed, 10-year fixed, all very common loan types. Those are kind of the most basic of loan options. Now, in addition to that, you have what they call a hybrid ARM, hybrid adjustable rate mortgage, not my physical ARM, okay? Hybrid ARM adjustable rate mortgage. ARMs got a little bit of a bad reputation during the housing crisis. They had a lot of quirky loan features that for the most part do not exist. And I say for the most part, make sure you're asking these questions if you are looking at an ARM. But a lot of them would have a prepayment penalty. You were not allowed to pay off your loan early back in the day. A lot of them would have this kind of quirky loan feature called negative amortization. Fancy term. Negative amortization means they would give you your payment and then they'd say, hey, look, you can make an optional payment that's less than that. And if you do, we will simply add on years to your loan. So a 30-year mortgage would become a 31-year, 32-year, 33-year loan. Your loan would increase in length if you made an optional payment that was less than the typical monthly payment. Again, kind of crazy loan terms. A lot of them would have what they call a balloon payment or a bullet payment, same exact term, or basically, sorry, synonym. So bullet payment and balloon payment mean the exact same thing, which is partway through your loan term, the remaining balance would come due in full. Hey, you're 15 years in, the remaining balance comes due. Most ARMs these days do not have that either. A lot of ARMs would not have a maximum adjustment. They could adjust at will, no limit overall. They could adjust from day one. All those kind of quirky loan features for the most part really disappeared. I joke that when the housing bubble popped, lending got rather boring. And when I say that, I mean that a lot of these quirky loan features kind of disappeared. So today's ARM is what we call a hybrid ARM, which means it has an initial period of time where the rate is fixed. 3 years, 5 years, 7 years, 10 years is the most common. So they have an initial period of time where the rate is fixed. And then after that initial time is when the rate begins to adjust, okay? So we, again, primarily will do 5 years, 7 years, 10 years. Those are the most common. The 3 and 5 year have a 2-1-5 format, which means there's up to an initial 2% adjustment after the initial fixed period, okay? Then it's 1% each additional adjustment up to a maximum of 5% above your initial rate. So there are caps overall. You can only increase 5% above your initial rate. There's initial caps. There's subsequent caps after that as well. again, yesteryear's arms, pre-2008, didn't have these limitations. They could adjust without any limitation immediately, no maximum, no minimum. They would just start adjusting. Today's arms are not like that, okay? 7 and 10 year, slightly different format, 5-1-5. Up to 5% the initial adjustment, 1% each adjustment after that, 5% overall. So why would somebody pursue an ARM? Well, right now they're pretty popular because rates are high. And when you get an adjustable rate mortgage, you're doing so almost entirely because the rates are lower. That's really the primary reason you would pursue an ARM. Another reason somebody might pursue an ARM is if they're here on like a work visa. Hey, I'm here on a work visa. I have to be out of the country in 3 years. Well, great. Let's do you a 3-year or 5-year ARM. Take advantage of that low rate in the meantime. And then when you go to sell a house before you leave the country, you'll have taken advantage of that low rate. Okay. So that might be another reason as well. Or you might be a first-time home buyer and saying, hey, look, I'm only going to be in this house for a couple of years before I go on to my next house. Great. And do you have any interest in being a landlord? No, I have no interest in being a landlord. I'm not going to rent this property out. Okay, great. Pursuing an ARM might make financial sense. Another reason somebody might pursue an ARM is because they might have to. And by that, I mean portfolio loans. Okay. I mentioned at the very beginning, banks, credit unions were very quick to lend out government money. We're a little bit slower to lend out their own. And slower doesn't necessarily mean, hey, the process is going to take longer. Process is about the same length of time. But it means we're probably going to prefer to do an adjustable rate mortgage. And there's a number of reasons why you might pursue a portfolio loan, which we're going to be talking about in a little bit. So keep that in the back of your mind. There's fixed term mortgages. There's also adjustable rate mortgages. Now, when a lender looks to get you pre-approved, we look at what we would call the 3 C's. The first C is credit, okay? First C is credit. Credit is the likelihood of you repaying debt in the future based on your past performance. And specifically, mortgage lenders are going to use FICO Model 8. FICO is Fair, Isaac and Company, okay? They were 2 people that decided to come together and create a standardized algorithm to calculate credit scores. Fair and Isaac, okay? So they came together, they established a static algorithm to calculate a credit score so that if a lender in Colorado was pulling credit, they would get the exact same score as somebody that was in New York, California, or Florida, or wherever, okay? If you're using the same model, you'll get the exact same score. Today, we use FICO Model 8. So it's the 8th iteration of FICO. Within FICO, there's 5 different pieces that will lead up to your credit score, that will equal your credit score. The brunt of your credit score comes from this. 35% of your score is payment history, okay? And that is, have you made your payments on time? Simply put, have you made your payments on time, okay? If you've made your payments on time, 35% of your credit score will be taken care of. Right off the bat, single best thing you can do for your credit score, pay your bills on time. They will not report you late to the credit bureaus until you are 30 full days late. So if you're ever like stressing because, oh no, I got my credit card bill on the 1st, but I forgot to pay it until the 15th, you might have a late fee involved, but you're not going to have a ding on your credit score, okay? So it might suck kind of having a little bit of a late fee, but you're not going to have to worry about your score getting dragged down. 35% of your score is simply, have you made your payments on time? 30% of your score is amounts owed. And really what that should say is amounts owed relative to the amounts you could owe. Specifically, revolving accounts. Revolving accounts are credit cards, okay? This is the single easiest way to improve your credit score. It's also the single quickest way to hurt your credit score, okay? You want to keep your balance to limit ratio at 30% or less. So if you have a credit card limit of $1,000, ideally, you do not want to use any more than $300 of that credit card. 30% of your limit, you want to keep your balance to limit ratio at 30% or less. Okay. If you ever notice like wide variations in your credit score, it's typically because of this. It's typically because of this portion right here. Okay. We tend to notice lower credit scores after the holidays. People charge a lot of stuff to their credit cards. They sometimes went over 30% of the limit. Score is going to start to go down. If you go over if you go over 50% of your limit, your score is going to plummet. So if you ever notice wide variations in your credit score, it typically has to do with this portion right here. And it's a huge chunk of your score, 30%, huge chunk of your score. Now, with that, people always ask the question, well, I pay off my credit card bill in full each month. That doesn't necessarily matter. The information gets passed along to the credit bureaus once every 30 days, and it tends to be when your credit card statement generates. So if you're like most people, you do not pay your credit card bill until your credit card bill actually shows up. Credit card bill shows up, pay my credit card bill. It's too late. That information's already been passed along to the credit bureaus. How much you owed, what your payment was, all of that stuff is going to get passed along. So the only way you can kind of get ahead of this is either to never utilize more than 30% of your limit, okay, or to pay your bill before your bill comes due. You pay your bill before that bill comes due. Bill generates on the 1st. I'm just going to log in each month on the 25th and pay that bill in full. Great. Now when that bill comes due, it's going to show $0 balance, $0 payment, and that's the information that will get passed along to the credit bureaus. Okay. So if you're worried about your credit score at all, keep an eye on that. Quickest way to improve your score. You can pay down your bills, leave them at less than 30% of your limit, and then 30 days later, you're going to notice an improvement in your credit score. Very quick, very easy, and something you might already do actually naturally. It's just kind of doing it ahead of schedule. Okay. Especially keep an eye on those credit cards with a very low limit. Those are the ones that are the hardest. Okay. So Kohl's cards, renowned for giving you like a $300 limit or a $100 limit. That does us nothing. You can use your card one time at the gas pump and you might be over 30% of your limit. So if you have a really small limit, maybe look at possibly increasing the limit on your credit card. It can very well increase your credit score. 15% of your score is going to be length of credit history. You've probably heard before, hey, don't close out any credit cards. Why is that? Well, it's because of this part right here. 15% of your score is length of credit history. Credit cards tend to be the oldest accounts that people have. If you have a car loan, it's typically a 5-year loan, maybe a 7-year loan max. Well, great. After 5 or 7 years, it's gone. Poof, bye, gonzo. Credit cards tend to be the oldest accounts folks have. I've seen some people with credit cards that have been opened since 1980. Obviously, they've gotten many different cards since then, but it's the same account number, okay? And so it still counts as the exact same account. So length of credit history, if you are going to close out extraneous accounts, make sure you're trying to close out the newer accounts, not the older accounts. The older your credit history as a whole, the better your credit score is going to be. 10% of your score is new credit. That's two different things, okay? One is anytime you open up a new trade line. Trade line is any loan, any credit card, anything that shows up on your credit report, okay? That's the technical term for those is trade line, okay? So anytime you open up a new trade line, mortgage, anything, it's going to drop your score for about 6 months. If you ever get a new car loan, a new credit card, a new mortgage, you're going to notice a little bit of a drop in your credit score for about 6 months. After 6 months, it'll start to benefit your score. For the first 6 months, your score is going to get lower. So that's one piece of it. The other piece of it is what they call credit inquiries. Anytime a lender checks your credit, it's going to drop your score between 3 and 5 points, and it's going to drop your score for about 90 days. So new credit applies to, hey, I actually opened up a new account, as well as has anybody checked your credit recently? If you've had any recent credit inquiries, that will drop your score between 3 and 5 points. Now, there's one exception to that. I guess really two exceptions to that, both of which are if a lender for a mortgage, 1, or a car loan, that's 2, check your credit within a 14-day window, it's only going to count as 1 inquiry. So if you are having multiple lenders pull your credit for either a car loan or a mortgage, have them do so within a 14-day window. That way it only counts as 1 credit inquiry. The government did not want to punish folks for having them shop around for the best terms. So they allow you to do so for both a car loan and a mortgage. That does not work for credit cards or personal loans or any of that, okay? They assume if multiple credit card lenders are checking your credit, you're trying to get access to multiple credit cards. Not the case with a mortgage or a car. Lastly, 10% of your score is types of credit used. Now, don't fall out of your chair, okay? They say you should have 3 credit cards for every 1 non-credit card. So if you have a student loan and a car loan, you should theoretically have 6 credit cards. I warned you. Don't do that. It's not necessary. It's only 10% of your score. You can certainly have perfect credit without having a 3-to-1 ratio of credit cards to non-credit cards, okay? That being said, I will say that having a credit card, ideally at least 2, is going to be really good for your credit score. If you're somebody that has survived using only cash as well as like personal loans and car loans, that kind of thing, your credit score is going to be lower than it would be if you had credit cards involved in the mix. The reason being, and I guess FICO's logic here, is that credit cards show a level of discipline that non-credit cards do not. Okay, with an auto loan or student loan, you just set it up on auto pay, you set it and you forget it, right? Not the case with a credit card. With a credit card, you are actively managing your debt. Every month the bill's going to change. Every month the payment's going to change. You have to make sure you're not going over your limit. It shows a level of discipline that non-credit cards do not. So credit cards are the single best thing you can do for your credit score, so long as, again, you're keeping your balance limit ratio at less than 30%. Okay. Aside from the credit score itself and conventional financing, again, it's going to be covering anything typically 680 or above. Sometimes you can get a conventional loan approval down to a 620 credit score. little bit more hit or miss once you get below 680. If you read conventional guidelines, they really say, hey, we want to see a 680. Government loans typically want to see a 620. Again, there are some types of government loans that will go all the way down to a 500. Once we get below a 620, chances of approval are significantly less. Okay. And then portfolio loans. There might not technically be a minimum with a portfolio loan because, again, it's the bank or credit union establishing their own guidelines and limitations. 680 plus for conventional, down to a 620 typically for government loan. Portfolio, not applicable. There really isn't a minimum necessarily. All right, so besides the credit score itself, lenders are going to care about a number of different things. Late payments. Are you currently late on any debt? That could impede your ability to get a mortgage. Typically, it's just because you didn't know about it. I had somebody earlier this week, even they weren't aware that they were late they were behind on a payment. So they brought that payment current rather quickly. We were able to do a rapid rescore, tell the bureaus, hey, your information's out of date. Please update your records. They made a payment. So we can update that rather quickly. Collections. Collections do not typically have to be paid off to get a mortgage. It depends on the overall balance. Okay. If you owe less than a couple $1,000s, typically a collection is not going to be required to be paid as part of your mortgage. When we run it through the automated underwriting system, the automated underwriting system is the system lenders use to find out if your loan is eligible for financing with Fannie Mae and Freddie Mac, with FHA, VA, that kind. So collections not typically required to be paid off unless the balance is really big, in which case it very well may. Charge off. Charge off means you owe debt to a creditor for so long that the creditor just threw their hands in there and said, we're never going to see this money. We're just going to take it as a loss on our books. They are charging it off their books. That's where it cuts the term charge off. You fought the law and you kind of won. And the reason I say kind of is because it's still going to drag down your credit score. It's going to drag down your credit score kind of indefinitely. So you might not be required to be paid off as part of a mortgage. Getting a mortgage, I've certainly had plenty of people get a mortgage with a charge off on their account, but it is going to continue to drag your score down through the mud, kind of indefinitely. And then judgments. Judgments are you legally owe somebody money. It could be delinquent taxes, it could be outstanding child support or spousal maintenance payments. Again, tax liens are very common. Lawsuits, maybe you lost a lawsuit and you technically owe somebody money legally. Judgments are required to be paid off prior to closing. So late payments, we'll probably have you rectify that rather quickly so we can get your credit score up, get you better pricing. Collections, charge-offs don't typically have to be paid off, depends on the balance. Judgments definitely have to be paid off prior to be able to get a mortgage. All these loans are government backed in one way or another, right? So if it's not truly Uncle Sam's money, they're backed by the government, or we are NCUA insured, or FDIC insured if you're talking to a bank. In the end, they're all government backed in one way or another. Okay. Even if it's Elevation's own personal money, we are insured by the NCUA. So because of that, judgments legally owing somebody money is going to impede your ability to get a mortgage. You're not really going to be able to find financing if you have an active judgment. All right. So I mentioned 3 C's. There's credit, there's capacity. Capacity is 2 different components. It is your down payment as well as your debt to income ratio. We're going to be talking about both of those. And then the third C is collateral. Buying a house is a little bit unique in that the lender actually cares about the house you're buying. If you go buy a car, the lender doesn't ask to see the car. How many miles are on it? What's the Kelley Blue Book value? Great. Here's your keys. Have a great day. Not the case with the mortgage. The lender absolutely cares about the house that you're buying. So we're going to be talking about the down payment side, which is, again, one of the components of capacity. So down payment. A term you're going to hear a lot from a lender is called loan to value, or LTV. Okay. Simply put, it is your loan amount divided by the value of your house. Loan amount divided by the value of your house. As a first-time home buyer, which is defined as anybody who has not owned a house in the last 3 years. Okay. First-time home buyer, you can put as little as 3% down on a conventional loan. For an FHA loan, you need 3.5% down. Okay. So 3%, 3.5% down, depending on the loan option that we're looking at. In those situations, your loan to value would be 97%. Loan amount divided by the value of your house. Or if you're doing FHA, again, 3.5% down, it would be 96.5. Okay. So you might have heard before, very common kind of misconception that's out there. Hey, you need 20% for a down payment on a house. That's not the case. What they're saying is you need 20% down if you want to avoid mortgage insurance. Okay. Every so often I'll have somebody walk in my office and say, hey, I want mortgage insurance. And I'm like, you are confused because mortgage insurance is not something you want. Okay. Mortgage insurance is a necessary evil anytime you put less than 20% down. It's insurance that you pay for that protects the lender. Okay, insurance you pay for that protects the lender. With a conventional loan, and it's one of the reasons why it's the gold standard, the mortgage insurance is removable. We're going to be talking about 4 different ways to get it removed in just a couple slides here. Okay, so it's removable. You can have it. It's temporary in nature. You will not have it forever. That is not the case with an FHA loan, and is the single biggest disadvantage to FHA. Again, Federal Housing Administration used to be a first-time home buyer program. Now it's more of a low credit score program. Okay, so FHA, they're going to have your mortgage insurance be permanent. You are stuck with it forever. The only way to get removed is to refinance into a conventional loan. Okay. In addition, conventional financing is only going to require you to pay mortgage insurance on a monthly basis. FHA requires you pay mortgage insurance twice, both an upfront fee as well as a monthly fee. So FHA gets you twice. Conventional is only going to get you once. When I talked about conventional being objectively kind of like the best loan, this is one of the big reasons why. Cheaper mortgage insurance, assuming your credit's in good shape. Temporary mortgage insurance, you pay for it monthly, not both upfront and monthly like you would with FHA. Okay. Now, one of the advantages of putting more money down, one of the obvious reasons you might do that is to get your payment down. But one of the other advantages of putting more money down is your mortgage insurance is less. Okay, so conventional mortgage, these are some quotes, estimates based on a 740 plus credit score. These are represented, a lot of math here, sorry in advance, but I'll explain. So these are representative per $100,000 loan amount per year, but you will pay it on a monthly basis, okay? So if you have a $300,000 loan, you would multiply these by 3 and then divide them by 12 to come up with your monthly premium. Now, it's not purely based on your down payment and your credit score. It's also based on debt to income ratio, which we're going to be talking about in a little bit here, but it is based on how well qualified you are. Okay, so these are rough estimates. If you're trying to figure out like, hey, look, should I save up 20% down? It's going to take me a while, or should I just put 3% down and have monthly mortgage insurance? I have an opinion on that, but if you were trying to run the calculations on your own, these are the calculations you would run. So it's per loan amount, not sales price, and it's reflected based on whether you put 3, 5, 10, or 15% down. So to that end, we don't see a lot of people doing like 4% down or 7% down. You certainly could, but your mortgage insurance rate is still going to be as though you put 3% down or 5% down. Okay, so it's going to slide to that lesser down payment. Okay, if you put 4% down, you're still going to have mortgage insurance at 3% down rate. Okay, so in this case, if you put 3% down, it'd be $690 per $100,000 loan amount per year. Again, represented as a monthly figure. 5% down, $440 per $100,000 loan amount per year. 10, $290, 15, $190. Okay, so the more you put down, the better off you're going to be. It's not that you can't put 7% down, you absolutely can, but your mortgage insurance is still going to be at the 5% down rate. Another very common follow-up question is, well, does that mean as I pay down my loan, my mortgage insurance is going to get less and less and less? The answer there is no. Once you have mortgage insurance, it's going to be at that rate until you get it removed entirely. So, Aaron, how do I get mortgage insurance removed? So glad you asked. Thank you so much. So mortgage insurance. With a conventional loan, you can get it removed, like I said, in 4 different ways. Okay. So number 1, this is the worst case scenario. Okay. This is you fall asleep at the wheel. You fall asleep at the wheel. You make your payments on time. You fall asleep at the wheel. You forget you have mortgage insurance. It'll fall off naturally when you're scheduled to reach 22% equity. Okay. It'll fall off naturally when you're scheduled to reach 22% equity. Now, scheduled is the key word here. It's not when you do reach 22% equity. It's when you're scheduled to reach 22% equity. Okay. So again, worst case scenario. If you were to put 5% down, it's typically about like 10 years into the loan. That is worst case scenario. We do not want to wait for that. We will get mortgage insurance removed. I would hope. Mortgage insurance, again, doesn't do you any good. It's insurance you pay for that only protects us. Okay. So we want to get it removed on your behalf as early as we possibly can. Number 2, second way, when you refinance, you can have mortgage insurance removed if you have at least 20% equity on the new loan. Okay, that one makes kind of obvious sense. If you have 20% equity, so your loan to value is 80% or less when you refinance, you do not have to have mortgage insurance on the new loan. Just like you wouldn't have to have mortgage insurance if you put 20% down from the get-go. Okay, so that one's relevant right now because there's a saying in this market where you marry the house but you date the rate. Any loan you're going to get today, you're likely going to be refinancing in the next year or 2 anyways. As rates are expected to come down, you're going to be refinancing to get your rate lower. When you do, maybe you have 20% equity. Maybe we can get mortgage insurance taken off for you. Or maybe it'll be at a reduced rate. Maybe all of a sudden you've got, 15% equity instead of 5% equity. Great. At least you're going to have it at the lower rate. Okay. Number 3, within the first 2 years, if you actively pay down your loan and you reach 80% loan to value based on the original value, you can petition to have it removed. Couple caveats here. Number 1, original value. Within the first 2 years, they will only use what you originally purchased the house for or the appraised value, whichever one is less. Okay, so they will not use any appreciated value within the first 2 years. And then the second kind of caveat, as I mentioned, at the lender's discretion or petition to have it removed, that all means the exact same thing, which is we're going to need to do an appraisal. It's a little bit of a different appraisal process than when you're buying the house, but we need to make sure the house is at least worth what you originally paid for it. Okay, so within the first 2 years, actively pay down the loan, 80% loan to value based on the original value, get it removed. Okay, number 4. By far and away the most common, especially along the front range. Okay, so number 4, after 2 years, you can petition to have it removed based on an appreciated value. So after 2 years, you can use a new value. Yay. Again, you have to petition for it, or it's at the lender's discretion, which means, again, appraisal is going to be needed. We have to find out what that house is worth now. Okay. Last caveat here is you have to have 25% equity. So if we're using the original value, you only have to have 20% equity or 80% loan to value. In scenario number 4, using a new value, you have to have 25% equity, or we need the loan to value to be 75%. Okay, those are the exact same things, different sides of the same coin. Okay, why 25% equity? It's an insurance company. They want their money. I don't have a great answer for you. They're also worried about variability in values. They're worried about markets going up and down, up and down, up and down. 25% builds in a little bit of cushion for the same reason that it's 80% of the original value within the first 2 years. Like, markets will change in the first couple of years, but using the original value at least is going to kind of limit that variability somewhat. All right, so acceptable sources of down payment. Ultimately, for closing, okay, so you don't need this money when you're getting pre-approved, but ultimately for closing, and I'm sorry, one last thing. I told you what would I do if it's between, hey, look, I've got 5% for down payment. Should I just keep saving up money until I reach 20% to avoid PMI? My argument would be no. Most people, and everybody's different, more than happy to talk to you individually, of course. But most people, their pace of savings is not going to keep up with the pace of appreciation in homes or the cost of homes increasing. So it's typically better off to get your foot in the door with regards to the real estate market, and then you'll refinance, or we'll get PMI removed in the future, and we'll get it removed. So don't let the existence of PMI slow you down from trying to get a house. It's there so that you can get into the house earlier than you otherwise would. If every homeowner had to wait until they had 20% equity, almost nobody would be buying homes. So that would be my argument. Get into the home, build up the equity. Your PMI is going to be temporary in nature anyways. All right, so down payment money. Ultimately, for closing, you're going to want your funds to be in a liquid account. Liquid is defined as savings, checking, or money market. That means you can access 100% of that money immediately. You can wire it, you can get a cashier's check, you can access your own money immediately. Okay. Ultimately, for closing, you want your funds to be in a liquid account prior to closing. Okay. Now, setting that aside, you could certainly use retirement accounts for the purpose of buying a house. 401ks, you can typically do a hardship loan. They call it hardship loan. Hardship loans are typically granted in the case of divorce, sometimes death, or first-time home buying. Okay, I don't know why buying a first home is considered a hardship, but it's the term that they use. With the 401k, you can typically borrow your own money from your 401k and then pay yourself back with interest. Kind of a nifty arrangement, actually. And if you ever talk to a wealth management advisor, they'll be like, "Don't do this, don't do this, don't do this." The skeptic part of me says they are saying that because they're getting paid based on how much you have with them. So taking money out of your 401k, they might not like it. The other part of it is if you do not repay that loan, there's significant tax consequences for early withdrawal. Usually with a 401k, and this is the only other thing I would recommend you check into, usually with a 401k loan, instead of contributing to that 401k, they will still have you take money out from your account each month, your pay stub each month. But instead of it going towards contributions, it's going towards repaying that loan. So a lot of times 401k loans, they will not allow you to continue contribution to the 401k above and beyond the repaying of that loan until it's repaid. Keep that in mind. Ask your 401k provider if that's the case, because those rules do differ. I would ask your 401k provider, how much can I get access to? What are the terms of repayment? Can I contribute to this 401k while I'm in the repayment stage of this? But yeah, it's not bad. You typically borrow your own money and pay yourself back with interest. Not a terrible arrangement. Early withdrawal would be a significantly different conversation. There are tax implications. There are, early withdrawal implications associated with that. Roth IRA. So Roth IRA is post-tax money. You've already paid taxes on the money, and now you're contributing to a Roth IRA. Okay. With a Roth IRA, you can access the amount of money you've contributed to that account. You cannot access the money that your money's made. Okay. So you can take out what they call the principal, the amount you've contributed, but you cannot access the money your money's made. So if you put $5,000 in a Roth IRA and now that account is worth $6,000, you could access the 5, but not the extra 1. Okay. No requirements for that. It's your money. You've already paid taxes on it. You can take your money out. IRAs. IRAs tend to be a little bit more challenging. They tend to be a little bit more challenging because for the most part, they started off as a 401k and they're no longer a 401k because typically, not all the time, but typically you're no longer working for that employer. So you've taken your old 401k, you've put it into an IRA, which means you're not really contributing to that account anymore for the most part. And if you're not contributing to that account anymore, it's going to be a lot harder to repay loans. Ask your wealth management advisor, Fidelity, Charles Schwab, whoever, do I have access to any of this money if I'm not of retirement age for the purpose of buying a house? You might get a very quick no. They might have some alternative arrangements as well, but double check with them, see if you can access the money. Let's talk about non-retirement accounts. So stocks, bonds, mutual funds, basically brokerage accounts, okay? Brokerage accounts are perfectly fine for buying a house. Prior to closing, you will want to liquidate those funds. You'll want to sell them from their stocks, bonds, mutual fund positions, put them into a liquid account, savings, checking, and money market for closing, okay? But absolutely, those funds are perfectly fine. We can use 100% of those monies, okay? Gift funds. When it comes to buying a house, the government allows you to get a gift from family or a familial-like relationship to buy a house. So if your parents or grandparents or aunt or uncle or whoever wants to help you with buying a house, they could gift you money. We will issue a gift letter that says, hey, this is a gift, not a loan. We'll actually send you the letter. You and them will both sign it. It has the amount that they are sending you, it has your relationship and where the money's coming from. You'll both need a signing. And the important part of that is it says, this is a gift, this is not a loan, okay? Loans are tricky. Loans, typically when it comes from family, are not against an asset. And if they're not against an asset, the government says you cannot use that loan for the purpose of buying a house. Gifts are a very eloquent solution to it, so long as they do not mind signing a gift letter. We also, last piece of the puzzle there, we also have to show the transfer of the funds occurring. Transfer from them to you, very common, or transfer from them directly to the title company. We're going to be talking about title companies in a little bit, okay? But ultimately, the funds will need to end up at the title company for closing. If they want to send their funds directly to title, works for us, okay? Loans against assets owned, okay? Loans against an asset owned. So if you have a car and you don't have a loan on that car, for instance, you could take out a loan on that car and use that money to buy a house. Use that money as a down payment money to buy a house. Perfectly fine. I do have to count that payment against you. We're going to be talking about that on the next slide. Okay. Loan from a 401k. That's another type of secured loan. Secured just means it's tied to an asset. We can use secured loans for the purpose of buying a house. Unsecured loans, like I mentioned earlier, are not acceptable. So you can't do like a cash advance on a credit card and use that money to buy a house. Government says, no, that's not okay. It has to be a secured loan, only secured loans for the purpose of buying real estate. Allison, no questions yet. I'm surprised. I know I'm doing a good job, but I didn't know I was doing that good of a job.
Yep, nothing yet. You're doing a great job.
All right, upwards and onwards. Let's talk about debt to income ratio. Okay, so again, credit is the first C, capacity is the second C. Capacity is both down payment, which we just covered, as well as debt to income ratio. Debt to income ratio is what's going to limit most folks. Okay, not all. Everybody's got a different one I call a limiting reagent. Okay, limiting reagent is some component that's going to limit ultimately your ability to buy. For some people, it's their credit score. So for some people, it's their down payment monies. For most folks, it ends up being their debt to income ratio. That's ultimately going to limit them. So debt to income ratio, it is the ratio of your debts plus the new mortgage payment over your income. This is the exact equation lenders are going to be doing when you call lender get pre-qualified or pre-approved. Okay. So first of all, we have to calculate your gross monthly income. Gross monthly income. you have a salary, we're going to take your monthly income prior to any deductions, prior to any 401k contributions, medical deductions, tax deductions. We care about the gross figure, okay? We're then going to multiply that by 35% or 50%, depending on if you're conservative or aggressive, okay? People always get a little bit confused by that. So monthly gross income times 0.35 if you are fiscally conservative, okay? Not politically conservative. We won't have that conversation, especially in an election year. Monthly gross income times 0.35, okay? That's where we're going to start. Or if you're a little bit more aggressive, if you say, hey, look, I don't have any kids. I'm not planning on having any kids. I don't like to travel. I'm kind of a homebody. My home is my biggest asset. It's where I'm going to spend most of my time. Or, hey, I'm on a pretty steep income growth curve. I'm only entering my career. I'm only going to be making more money. I feel comfortable with a more aggressive mortgage payment. Great. Monthly gross income times 0.5. That's how we're going to start that equation, okay? Then we're going to subtract out any monthly debts that show up on your credit report. So if you did get a car loan, like I said, loan against an asset you own, you did get a car loan, this is where I would have to take into account that payment. Okay. Credit card payments, we're going to use the minimum credit card payment. Student loan payments, always a big topic of conversation. Student loans, if those are currently in deferment, I have to use either 0.5% for Freddie Mac. Again, that's one of the two government-sponsored enterprises, or 1% for Fannie Mae of your student loan balance as the payment that's due. So if you have $100,000 in student loan debt, I have to count a payment of $1,000 for Fannie Mae or $500 for Freddie Mac. So those payments can get really cost prohibitive really quickly. If they're not in deferment, whatever payment is being reported is the payment I can use for qualification. Okay. So, a few months ago, before student loans were coming out of deferment, this was popping up everywhere. And I'm like, we really need you to start repayment on your student loans because your payment's too cost prohibitive to qualify you for a mortgage. Not a big deal. You can take them out of deferment, start payments early, and I could now use that payment to qualify. Also, if you're on like a more accelerated payment plan, maybe we have you switch to a, graduated repayment plan or an extended repayment plan for the purpose of qualifying for a mortgage. Like, just because you're on an accelerated plan doesn't mean you have to be, right? We could always have you pivot to a different plan if we need to. When we do this equation, gross monthly income times, again, you can kind of decide if you're fiscally conservative or aggressive or somewhere in between. Subtract out any monthly debts that show up on your credit report. Whatever remains is the max housing payment a lender can qualify you for. When somebody calls to get pre-qualified, which is kind of back of the napkin, tell me your income and your debts, and I can tell you ballpark what you qualify for. This is the exact equation we do, okay? So yeah, that's kind of the equation lenders are going to do. Now, keep in mind, there's always something more, right? If you're going from renting to buying, which presumably is most of the folks on this seminar, there are going to be some things you need to plan for, okay? That aren't factored into your debt to income ratio that do need to be factored in on your end. Maintenance and unexpected repairs. Days of renting, water heater breaks, you just call your landlord and they send somebody out to take care of it, and you are out $0, right? A little bit of inconvenience, cold shower or two, but your landlord's going to take care of those costs. Not the case when you buy. Not the case when you buy. When you buy, it's now on you. Okay, so you need to plan accordingly. Potential increase in utilities. Typically, when you're purchasing, right, you're going to be moving up in size of homes, unless you're, maybe of retirement age, and now you're going to be looking to what we call right size, move down in size. But usually, folks are looking for more space. That means your utilities are likely going to be increasing. If you're buying a condo or a townhome, you're going to have to worry about HOA dues, homeowners association dues. When you buy into a condo or townhome, you are now automatically part of the HOA, whether you want to be or not. You will sign a piece of paper at closing saying, I agree to abide by the HOA's rules and regulations. You are now part of that HOA. You are now part of that group of homeowners in that community that are in charge of paying insurance bills, paying for the maintenance of the roof and the exterior, paying for insurance for the outside. If there's tennis courts and pools, taking care of all that, maintaining green spaces, green belts, open parks, all that stuff is now part of the HOA's responsibility. HOA dues will increase, and they're especially increasing right now. And they're increasing right now because there was a lot of insurance claims last year to all the hail damage we had. And as part of that, a lot of the insurance premiums on these condo complexes and townhome complexes are increasing. And HOAs are kind of scrambling a little bit, like, oh no, we have to increase everybody's HOA dues to account for those increase in insurance costs. So keep an eye on that. When you're under contract on a condo or townhome, you'll be asking a lot of questions. One of the questions you should definitely be asking is, hey, how often have the HOA dues been increased and how significantly? That information is readily available to you as a homeowner. Okay. All right. So talk briefly about getting pre-qualified. Very back of the napkin. More than happy to start there if you want. If you're just trying to get your ducks in a row and see if you're in the right ballpark, yeah, give us a quick call. I can run you through a pre-qualification. It takes a solid 5 to 10 minutes. Okay. The more formal process is what we call pre-approval. Okay. So pre-approval is where you would actually fill out an application. Application is going to entail to your work history, to your address history, social security number, birthday. We're going to do a credit pull for you. Pretty basic information you'll know off the top of your head. Asset information, how much you have and who you have it with. Again, pretty basic information you'll know off the top of your head. Takes most folks about 20 minutes to complete it online. We could do it in person. We could do it over the phone, whatever you prefer. But most folks go online these days. Again, we're going to evaluate and determine what your income, debts, and assets are for qualification. Once we figure that out, I will then issue you a pre-approval letter. The pre-approval letter that we initially get you is generic in nature. Okay, it's got your name on there. It says you're qualified up to whatever upper limit the lender feels comfortable with, or you might feel comfortable with if you're setting a limit that's lower than what the lender feels comfortable with, which is a great scenario. I love it when folks are setting their own limitations instead of the lender doing it for them. But we're going to issue you a pre-approval letter for whatever that upper limit is. Okay, that letter's generic. It says TBD for the address, to be determined. Okay, once it comes time to actually make an offer on a house, I will get you a brand new letter. Okay, I'll get you a brand new letter specific to the address and price. I do not want to tell somebody you're qualified up to $500,000 if you're making an offer of $400,000, because the seller's just going to come back and ask you for more money. Okay, so the initial letter really is just for you and your real estate agent. Once you've been pre-approved, the next step in the process is to find a house. And that's the fun part, right? Everybody loves looking at homes. I mean, it might be stressful, but if you embrace the chaos, it can be a little bit fun. It's kind of like compared to like watching a movie and you're watching like the opening advertisements and everything like that. That movie, that trailer looks like garbage. What were they thinking with that trailer? That movie looks terrible. It's kind of the same when you're touring homes. Like, why would they pick neon yellow as a paint color? You gotta judge the home. But yeah, your next step once you get pre-approved is start looking at homes in earnest. So before you do that, you are going to need a real estate agent. Okay, you are going to need a real estate agent. How do you figure out what real estate agent to work with? You could ask your friends and family who they've used. Did they have a good experience? You could ask your lender. I only refer out the best agents that I know of. And I've been doing this for so long that I think I have a pretty good handle of who the really good agents are. You're going to want to ask your real estate agent, whoever you're working with, even if it is, a recommendation from somebody you know and trust. Ask them about their experience. How long have you been in real estate? How many homes do you sell on a typical annual basis? How many homes did you sell in 2023? Admittedly, it was a down year. How about 2022? Okay. You want to ask your agents how many deals that they are doing, because the average real estate agent in the USA does one transaction every year. If that doesn't alarm you, it should. It tells you that there's a lot of real estate agents that do very little business. A lot of agents have a license and they just do their own transactions if they're buying and selling. Maybe they do fix and flips for their friends and family. Maybe they only sell homes for their friends and family, or maybe it's a side hustle. Maybe they have a primary job and this is just what they do on the side. You want to ask them how much they're doing. A good real estate agent will average at least 6 transactions a year, and I would still argue that's kind of on the low end of things. Allison, questions before I get on with this?
Yeah. In your opinion, is it a good idea to work with multiple agents?
It's a great question. I would interview multiple agents and figure out who you have a good comfort level with, who can give you the service that you need, who can communicate in the way you want it to be communicated with. And then you should really narrow it down and get one agent. Agents will have you sign a buyer's agency agreement, which says, hey, look, I agree to use you so long as I go under contract on a home in the next X amount of months. Agents are going to want you to sign that fairly early in the process. One, they're pure commission. So, using multiple agents is going to be, unfortunately, disappointing to somebody that's going to be spending time and energy getting paid ultimately nothing at the end. We're used to it in the real estate community. It happens. But you want to have those conversations earlier. Okay. So interview multiple agents, definitely. choose one agent early in the process and plan on using them would be my advice there. And then also you want to ask your real estate agents for references. Hey, can you give me a list of names and numbers of agents or buyers you've helped in the past that I could possibly talk to just to make sure that they had a good experience? Most real estate agents be like, no problem. Here's 5 different names and numbers. Have at it. Please do. They should have had good experiences in the past, somebody that they can rely on, somebody that they can lean on to give you that reference. I post all my references online. I do that for a reason. I want folks to know what kind of experience they can expect with me. Make the most of your relationship. Communicate clearly and often. That could be said for any relationship you got, right? You get out what you put in, okay? Communicate clearly and often. You are not being a pain in the you know what. You are only helping them figuring out what home you ultimately want to be in. And you're helping them really kind of narrow it down, okay? When you're looking at homes, keep track of what you liked and didn't like and let them know. They need to know if there's an automatic disqualifier when you go look at homes. They want to know it's only going to help them help you, okay? Potential pitfalls. In Colorado, you cannot be an agent for both the buyer and the seller simultaneously. There are some states where you can, which is a little bit ludicrous to me. How can you possibly negotiate against yourself? It's very hard to do. In Colorado, we acknowledge that and we say, yeah, that's not possible. You cannot possibly be an agent, a representative of both the buyer and the seller. It's just not possible. How can you possibly negotiate for both parties without negotiating against one party, right? So in Colorado, and why would this really come out? You go to an open house and you're like, ooh, I love this home. And then you say, hey, I want to buy this home. And you do not have agent representation. Your conversation needs to be immediately with that agent of, hey, if I make an offer on this home, who's representing who? Are you representing the seller whose house you're holding open right now, or would you be representing me? They may come back with a couple of different things. They may say, I would refer you out to somebody else to work as your agent for you if you don't already have an agent. Or 2, maybe in Colorado, they would become a transaction broker. A transaction broker means they do not work for the seller. They do not work for the buyer, you. They work for the transaction, okay? So if you said, hey, what price should I offer you on this house? They would say, I cannot tell you that, but here's a stack of data that might help you make a decision. They'll give you the data, but they can't convince you or give you a number to then tell the seller. They work for the transaction. Their job is to mediate the transaction, help both parties get to closing. Their job is not to negotiate for one party or another. If you did an inspection and you get your inspection report, you could go to the agent and say, hey, which of these items should I ask for them to fix? They would say, I can't tell you. I can't tell you. I cannot negotiate or work on either party's behalf. My job is to work for the transaction. I've got some agents that say they love being a transaction broker because it literally ties their hands and they can't do anything. they can't work for either party. They can't do anything on either party's behalf. They basically just work for the transaction. They say it's the easiest thing in the world to do. I've also spoken with some real estate agents say being a transaction broker is the worst thing in the world. They cannot be a transaction broker because they cannot possibly take their personal investment, their personal relationships, and set them aside and reasonably work for the transaction. So some agents will do it, some agents will not. I highly recommend you get a real estate agent. A good real estate agent will save you more money than they're going to cost you. It's just like a good CPA, right? They're going to save you more money than they're going to cost you. I used to have my real estate license. I know financing better than almost anybody else. And I still, to this day, will hire a real estate agent anytime I buy or sell. You have to know your strengths in life. And I'm not a great negotiator, be very honest. So I have to hire somebody that will be a good negotiator on my behalf. I tend to get too, close to the transaction. When I turned one of my properties into a rental way back when, I invited my tenants to my landlord. Or my tenants to my wedding. Like I quite literally invited my tenants to my wedding. Like I got way too close to them. I got way too close to the situation, too close to my tenants. Like I'm just that kind of guy. I'm just going to get too close to the situation and it's going to be very hard for me to be objective. So know your strengths in life. I would highly recommend getting a real estate agent. Ask them for references, ask them about their experience. Get a referral from friends, families, somebody else who's bought a house recently. If you don't have any names or numbers, call us. I only refer out the best. So when you're looking at homes, you really need to figure out what's negotiable and what's not, okay? What is a deal breaker and what's not? For some people, it's location. They want to be close to work or they want to be in a specific school district for their kids. Start with location. It's not something you can change. Start there. Then start looking at your life stage, right? Ranch style homes tend to be more expensive. They have a bigger footprint on the ground because they're not built vertically. They're built, lengthwise. And they tend to take up more space. They also tend to be more desirable because they are fewer and far between for that exact same reason. New construction, they love to stack homes kind of like right on top of one another. It's very hard to do that with ranch style homes. So there's just fewer of them out there. And we also have an aging population. And with that, they tend to like fewer stairs. Knees get old, can certainly appreciate that. They just don't like dealing with stairs as much, going up and down. Okay, so ranch style home might be more appealing if you're older. If you're younger, maybe you are fine with, hey, my knees still have plenty of miles on them. I don't mind going up and down stairs, get my little steps in. Great. You can probably find multi-level homes like a tri-level home or a split-level home for a cheaper price than you could a ranch style home. So where are you in your life? A large yard versus small patio. People automatically assume a large yard is nice. Large yards also require a large amount of maintenance. You have to lawn mow and take care of your trees and shrubs. Your water bill is going to be more expensive with all of that as well. Yes, my Irish setter loves the yard. I do not. It's a lot of work. So keep that in mind. Small patio, less maintenance. Less maintenance. I had a member today go under contract on a patio home. Very small yard. They don't have to worry about it. They're starting to get up there in age. It's easier to maintain. New construction versus existing home. I could teach an entire seminar just on this topic. New construction versus existing. There's advantages and disadvantages to both. Okay. New construction, you're going to be moving into a construction site. Unless you're the last home on the block that's getting completed, you're going to be moving into a construction site. So you're going to deal with construction noise. You're going to deal with construction traffic. You're going to be living in kind of a dust bowl. New construction sites are dirty, right? Right now, if you're buying new construction, they can't put down the landscaping. It's the middle of winter, right? So plan on that. Plan on having immature landscaping. Doesn't seem like a big deal. Well, if you have these little trees that are twigs, it's going to be kind of a privacy issue for a while. So just keep all of that in mind. With new construction, I also say you should probably be planning on being in the house for a longer period of time. And the reason I say that is I have seen people before buy new construction and then go to sell their house in a year or two, and the builder is still building. That means when you go to sell your house, you now have to compete with that same builder to sell your house. Somebody's going to come see your house and say, hey, this is great and all, but why would I buy your house when I could just go talk to the builder, pick out what I want and where I want it, and just buy their model and make it my own? Good question, right? Supply and demand, you're going to be competing with the builder. So I don't mind new construction, but you need to be planning on being in the house longer term. Also, new construction, your property taxes are probably going to be higher. Keep an eye on that. If you're ever looking at new construction, please, please, please ask the builder about the Metro Taxing District. Metro Taxing District is the elevated taxes on new construction that exists to pay for the infrastructure that goes along with new construction. New roads, new sidewalks, new utility hookups. All of that stuff is going to require money, and your taxes on new construction are going to be higher. Might be temporarily higher, a few years maybe, but it's going to be higher, and sometimes significantly so. Okay. Good thing with new construction, there's certainly some advantages. I'm not all negative on new construction. Some advantages of new construction are cheaper insurance. Brand new house, brand new warranties. Brand new warranties, insurance companies love warranties. So insurance is going to be less expensive. Yay. You don't have to live in somebody else's dust. Yay. You get to figure out your floor plan and your finishes. All good stuff. Okay. But plan on maybe being a little bit less comfortable. Existing home, lower property taxes typically, more expensive insurance, no warranties. So if stuff breaks, you have to worry about that as well. Okay. Tends to also be more mature homes, less construction site, less noise, that kind of thing. I'm not against new construction. Most first-time home buyers, when they're buying a home, I would, generally speaking, and everybody's different, but I would generally say steer clear of new construction for a lot of those same reasons I already described. One, most first-time home buyers honestly just don't know what they want. I've seen a lot of first-time home buyers do new construction and say, yeah, turn the loft into a bedroom. I really wanted it to be an open loft. I really needed that open space, and instead it's a bedroom, and I wish I'd done that differently. Sometimes you don't really know what you want until you're living in a home, and then you can kind of figure it out. Well, if you're 2 to 3 homes in, you might have a better idea of what you're getting yourself into. Also, most first-time home buyers, they don't plan on living in their first home for very long. So again, I mentioned that as well. Like, you don't want to be competing with that builder when you go to sell your house. So it tends to be a better longer term thing instead of a shorter term thing. Everybody's different. There's plenty of people to buy their home and they never move. Great. Yeah, have at it. Go do your thing. I'm all for it. So when you're viewing your home, you want to keep a couple of things on hand. Number one, I would bring a notebook. Make a list of the address, what you did and did not like, whether or not it's a contender or not. Okay. Take pictures if you have any concerns. Okay. Pictures are all online. Pictures always online make it look a little bit better than it really is. Real estate agents are great that way. Every house looks like a model, right? So take pictures if you have some questions or concerns. Tape measure, that would be if you have specific furniture. I've got a pool table that I need to fit in this house and needs to be specifically this long and this wide for these one rooms. You can always bring a tape measure. You're not going to have very many opportunities to see that home before you, one, make an offer. You might only see it once or twice. And then two, even before closing, you're not going to see that home very often. Initial preview, maybe you do a second showing if you're lucky. Maybe you're there with the inspector when they're doing the inspection. We're going to be talking about that in just a second here. Final walkthrough, a couple days before closing. That's it. You might literally only see your house 2 to 3 times prior to closing on that house. So take your time. If you do have any questions or concerns, bring a tape measure, take out your camera phone, take pictures of rooms if you have questions. Okay. Ignore easily replaced cosmetic features. They say the line all the time, paint is cheap. Paint and carpet, flooring are generally pretty cheap. So if you can ignore that, look past that and look at, the rest of the house, it's going to be giving you a little bit of a better, realistic picture of what your house is going to be. I was buying an investment property a couple years ago and I was like, what am I missing? Why is this townhome still on the market? And my agent at the time was like, the paint? Nobody could look past the paint. Bright neon pink and yellows, and it was just ugly. ugly. It's like Miami Vice or something. It was ugly. I was like, yeah, great, paint's cheap. Let's do this thing. Went under contract. No other houses in the area were on the market even. So yeah, you'd be amazed how many people can't look past the easily replaced cosmetic features. Evaluate storage areas if you're looking at needing to fill up some space. Bikes are very common in Colorado. Like, do you have an adequate storage facility for your bikes? Walk around the outside and look over the exterior and listen to the neighborhood. When my wife and we bought our forever home a few years back, and I was like, you ever notice that rush hour traffic noise? And she's like, no, I've never really noticed it. So you go out there on a cool morning where the air is a little bit more dense, and then you're like, oh yeah, I can totally hear 287, Highway 287 in the background. That it's not terrible. It's not going to change my opinion of our house, but yeah, you're not going to have many opportunities to see the house, and once you do get in, you will start to notice stuff. So one of the first things you're going to do once you get under contract is you're going to do an inspection. Okay, we're going to be talking about the actual process of going under contract in a second here, but when you do your inspection, there's a couple things to keep an eye out for in Colorado specifically. Number one is radon. Radon is a radioactive gas that seeps in through the foundations along the Front Range. It's not prevalent everywhere. It's more often prevalent in a basement. Okay, so if you don't have a basement, it's probably less of a concern. Very, very cheap to test for. You can even buy a at-home test kit for like less than $100. Test it, ship it off, they'll give you the results. Very cheap to test for. It's much more expensive to fix. They have to install a fan that literally will run through your basement and up through your house and kick out the air. So keep an eye on that. Cheap to test for, more expensive to mitigate. Always test for it if you have a basement especially. Bentonite. Bentonite is an expansive clay in our soils along the Front Range. It can create some structural issues. So if you notice some significant areas of settling, sidewalk cracking, it's very common. That doesn't always mean there's a structural issue or bentonite even. But if you notice serious cracking in cement, be on the lookout. Have your inspector ask them if hey, should I get a structural engineer out here to test for this? Structural engineer will be able to tell you very quickly, either via soil samples or measuring movement within homes, whether or not there is a settling issue. Structural issues can be horrendously expensive to fix. And it goes in veins underneath the ground. So one subdivision may be completely decimated by bentonite and have structural issues for every single home. And then literally a neighborhood over has like none. It's very, very interesting. So keep an eye out for that. Your basic inspector will let you know whether or not you should hire a structural engineer. And they'll err on the side of caution because their whole job is to mitigate risk, right? So ask your basic inspector whether or not you should be getting a structural engineer out there if they see any signs of settling that are of significant concern. Mold. We did not have mold in Colorado almost at all until the 2013 flood. And then mold started popping up. Mold, your inspector, again, your basic inspector will be able to give you an idea whether or not you should get a mold test done. You can do mold tests and meth tests if you're worried about whether your house is a meth lab. You can do allergy tests. They can do infrared tests where they do an infrared test to find out if there's any water or moisture behind your walls. Like there's a lot of different things they can do. Radon is very easy to test for. Your inspector will let you know whether you should hire a structural engineer or get a mold test done. Also worth recommending, and it's kind of related to the bentonite issue, but sewer scope. Sewer scope is very easy to test for, and a sewer line issue can be extremely expensive. So radon, sewer scope, and then a basic inspection at the very, very least, and then ask your inspector if there's anything else they should be doing. Sorry. So special considerations if you're buying a condo. Is there adequate parking? Is there adequate parking? Keep an eye on that. Revisit the home in the evening or first thing in the morning before people go off to work. It's very easy to get an impression of your condo complex middle of the day when nobody's home, and then you get a very different impression when people are at home. So try to stagnate your schedulings if you can. Maybe you do your first showing middle of the day on your lunch break, and maybe you do your second showing at 6 o'clock when people are actually home. Try to visit when neighbors might be home for that exact same reason. Check noise level. Are the common areas well maintained? You're going to be paying HOA dues. You want to make sure those HOA dues are going towards a worthwhile cause. Okay, taking care of the HOA, taking care of the paints, the siding, all that. HOAs, rules and regulations. Review them carefully. When you go under contract, you're going to get a stack of HOA covenants, rules and regulations. Read them carefully. It is slow, it is boring, it sucks to read it all. I promise you that, but it's totally worthwhile. You'll find out a lot of stuff about the HOA that you might not have known about otherwise. Also ask your neighbors when you're moving into a condo. Ask your neighbors, hey, how's the HOA? I mean, are they overbearing or underbearing? Have you had any bad experiences with them? Introduce yourself. Hey, I'm under contract to buy the house next door. Do you mind if I just ask you, like, have you had any bad interactions with the HOA? I'm just trying to get, an unbiased opinion. People love trash talking their HOAs. Okay. I've had multiple people move into a condo complex just to find out that there was rules and regulations about the size of their pets. And they literally had to make a decision. Do I either move or do I get rid of my dog? From a dog lover, that would just wreck me. So read those rules and regulations. It's your only chance to do so prior to moving in. So rule of 0, 15, 20, 35, and sometimes 50. What is that? So when the housing bubble popped, 2007, 2008, the government blamed a couple things. They blamed loose lending restrictions, which is why I have a job, honestly, because it's harder to get a mortgage than it used to be. They also blamed condos. They found out that when one condo gets foreclosed on in a complex, it starts to decrease the value of all the other condos in that complex because now they have to sell their house at a discount to compete with their neighbor that had to sell their house on a foreclosure or short sale. So they said, hey, look, we'll still lend on condos, but we're going to have some additional requirements for them. Once you go under contract on a property, we're going to pull a condo questionnaire to find out if your condo is warrantable. Warrantable just means that it meets Fannie Mae and Freddie Mac's requirements. Okay. So questions we're going to be asking them. And this is the rule. So 0, the complex cannot be in any litigation. Why would a complex be in litigation? Sometimes the condo complex is suing the builder for defects, perceived defects. I've seen some slip and falls. Somebody slipped and fell, and now they're suing the HOA because the HOA is supposed to take care of the sidewalks. I've seen crazy things like somebody was throwing a birthday party and they had a bounce house and the bounce house blew away and somebody got injured. And the HOA was being sued because the homeowner felt the HOA was responsible for allowing that bounce house there. It kind of covers all things. The concern with litigation is, well, maybe this litigation could cause the HOA to be in financial disrepair. Maybe the HOA no longer has the resources to be able to take care of what they need to take care of. Insurance, maintaining the property, all of that. It also cannot be a litigation. Okay, so I'm sorry, it can't be a condotel. Already talked about litigation. Can't be a condotel. Condotel is kind of a quirky loan feature where it might have some features of a condo, but also some features of a hotel. Okay, if you've ever like gone to like Beaver Creek or something like that, Aspen, and you're like in this condo complex that you rented on like VRBO, and you're like walking, you're like, is this a condo or is this a hotel? I can't quite tell. There's concierge service. There's a front desk check-in where I can literally rent the house, the unit by the night. They have room service. They have room keeping service where they'll actually take care of your, changing your sheeting and stuff like that. Like that's a telltale sign that it's a condo hotel. The government does not want to be in the business of condo hotels. 15, the complex cannot have 15% or more of the units be delinquent on HOA dues by 60 days or more. They want to make sure that everybody's paying their HOA dues and that nobody's seriously delinquent. 20, the complex cannot have one owner who owns more than 20% of the units. The concern there is if they did, and that owner went into bankruptcy, they could flood the market with a whole bunch of units to be sold. Supply and demand that could drag down your value. 35% of the complex or less can be commercial. So it can't be 35% or more commercial in nature. Concern there is Fannie Mae and Freddie Mac are in the business of residential financing. They don't want to tie their fate to commercial. Okay, so their concern is if there's a lot of commercial space, maybe the commercial space is these really desirable coffee shops and restaurants and everything's fine. What if they turned it into a bowling alley that's very loud, or a gun range? Okay, or what if you didn't like marijuana and they turned it into a marijuana shop? Maybe for some Coloradans that increases the value of the home. Maybe for some it decreases it. Okay, so that's their concern. Their concern is commercial tends to be a little bit more variable. Also, commercial tends to stay vacant for longer. And now that I mentioned that, you'll be like, oh, totally. Like you'll drive past some places, you're like, that commercial space has been vacant forever. Well, nobody really wants to move above a vacant warehouse. Okay. And then lastly, some lenders will tell you that if 50% of the units are investor owned, you cannot get conventional financing. This does not apply if you're an owner occupant. So if you get that response, hang up, call me. Okay. Elevations does not have that requirement. Our logic is the same as Fannie Mae and Freddie Mac's logic, which is regardless of whatever the ratio currently is, you're going to be making it either better or keeping it the same. That's it. So if you come across this, hang up, call us. Elevations are a little bit more reasonable when it comes to that. And a lot of things, honestly. All right. So we've gotten pre-approved. We looked at the, 2 of the 3 C's, right? Your credit, your capacity, down payment, debt to income ratio. We got you pre-approved. Had you run through an application. You interviewed your real estate agent. You found a real estate agent to use. Now you found your house and you want to make an offer. So now what happens? Okay. So you're going to make an offer. Your real estate agent is going to walk you through the Colorado contract. Fortunately, in Colorado, we use a standard form. You can download it online. It's wonderful. And the reason it's wonderful is because you don't have to worry about a lot of terms being invented as part of the transaction. The Department of Regulatory Agencies, DORA, has already established that. Okay. And every year they come out with a brand new contract to account for any changes that might have occurred to our real estate market or another lawsuit that might have showed up that now they have to put into their contract. Colorado state contract is like 27 pages long. Kind of intimidating, but your real estate agent is going to walk you through it the first time you sign one. Here's exactly what each of these clauses mean. Here's exactly the blanks that we're filling in. They're going to tell you what price they recommend offering you, whether or not you should ask for any seller concessions. Seller concessions is where you would ask for the seller to pay for some of your closing costs. Okay. They're going to submit that contract, and you're immediately going to submit earnest money to the title company. In Colorado, we do not use real estate attorneys typically. We use real estate agents and title companies. Together, they satisfy the function of what real estate attorneys would do in most other states, but they do it for a fraction of the cost that real estate attorneys would. Okay, title companies and real estate agents together, they do what real estate attorneys would do in other states. So the title company, they do a lot of different functions. Okay, they collect funds, they disperse funds. So instead of write like 20 different checks for 20 different fees, you write one check. The title company takes that money and then pays everybody that's owed money. Okay, they also will receive the earnest money. The earnest money is a deposit that you make at the very beginning, within the first day or two of going under contract, to show that you're proceeding in good faith. Okay, to show that you're proceeding in earnest. That's where it gets its name. You're proceeding in earnest. It's typically around 1% of the sales price. If you're buying a $300,000 home, it might be $3,000. Buying a $500,000 home, maybe $5,000. It's a negotiation. It's up to part of the negotiation that your real estate agent is going to do, but it's typically around that. Okay. You'll write your earnest money check, you'll deposit with the title company. The title company will hold those funds until either you successfully close, in which case they credit that money towards your closing, okay? Or you cancel the contract with regards to one of the many deadlines you have where you can cancel the contract, in which case they'll refund that earnest money back to you. Or extraordinarily rarely, if you do not do what the contract says you're supposed to do, that earnest money will get sent off to the seller and they will get to keep that money. The good thing is, a really good thing is, in Colorado, the contract is extremely buyer friendly. Okay. If you do not like your inspection, cancel, you get your earnest money back. Okay. We do an appraisal. You don't like the results, cancel, you get your earnest money back. Loan terms deadline, the buyer's sole subjective discretion. If you do not like the terms of your loan, you can cancel, you can get your earnest money back. Loan availability deadline, if your loan doesn't get approved, you can cancel, you can get your earnest money back. If you do not like the HOA covenants, the HOA rules and regulations, you do not like the fact that they have a weight limit on the dog, and you don't want to put Fido on a diet, cancel, get your earnest money back. Okay, very easy to cancel and get your earnest money back in Colorado. I've been doing this since 2009 on the financing side. I've only seen one person lose their earnest money. Okay, and that was somebody that bought a house sight unseen. They literally never seen it. They did their final walkthrough the day before closing and said, "Yeah, I can't retire here," and they ended up canceling and losing their earnest money. Okay, so unless you're doing something crazy like that, your earnest money is going to be protected. A good real estate agent and a good lender, they're going to make sure of that. Okay. We're also going to supply, like I said, an updated pre-approval letter specific to the address and price of what you're offering. Expect a counteroffer. Okay. Sometimes it's very innocuous of, hey, we need to move this deadline up or back a date because it's my seller's birthday that day or it falls on a holiday. Sometimes it's more regarding terms. Hey, we want a better price. Give us more money. Okay. But expect a counteroffer. Extremely common. So you've gotten under contract. Congratulations. Now what? We're going to update your application, see what's changed, make sure nothing drastic has changed since we started. You're going to give us a copy of the purchase contract. We're going to send you some updated loan numbers specific to that day's rate, that day's cost. Rates will change literally daily, Monday through Friday. Once you're under contract, we can update those numbers for you. We're going to send you some loan disclosures to sign. You'll electronically sign those. Most everything we do is online now. And then we're going to send you a list of what we need to process your loan. Pay stubs, W-2s, bank statements, all of that. Okay. So you're going to supply all that documentation to us so that we can get your file into underwriting, which I'm going to talk about in a second. Allison.
Yes, what is the average amount of earnest money?
1% of the sales price of the home. 1% of the sales price of the home is what I would plan on. It is up to negotiation. It will change slightly, but about that. Have that money at the ready. Have that money in your checking account, your liquid account. Make sure that money's at the ready because you will need it pretty much right away once you're under contract. Cool. So once you go under contract, like I said, you're going to drop off your earnest money. You're going to contact your lender. You're immediately going to schedule your inspection. You handle the inspection. Your real estate agent will have some names and numbers of inspectors. We're going to handle ordering the appraisal. Okay. The appraisal gets ordered to make sure that the house is worth what you're paying for. That's what it is. Okay. It is a valuation of your home to make sure it's worth what you're paying for it. Who does it? We have a panel of appraisers that we've previously vetted. We want to make sure only the most knowledgeable, experienced appraisers are doing the job. We also will limit the range that they can operate in. We try to keep our appraisers only allowing them to work in a couple zip codes. We do not want an appraiser coming up from Colorado Springs to appraise a house in Boulder or vice versa even. Okay. If it comes in low, a couple different things. One, you could potentially ask the seller to drop their price. Hey, we were under contract at $350,000. The house appraised for $340,000. We want you to drop the price to $340,000. Okay, and a low appraisal could be additional leverage, potentially. You could also just bring additional funds to closing. Hey, the price for $340,000. We're under contract at $350,000, but we really want the house. We're just going to bring the extra $10,000 in. We don't want the deal to fall apart. Okay. If it comes in high, you are the only person that knows about it. We do not want to tell the seller the house appraised high if it did. We only want you to know about that information. That appraisal is yours. You paid for it. Okay. So pitfalls to avoid: do not apply for any new credit during the process. Okay. Once you go under contract, we're going to update your application. We're going to make sure we have a valid credit report. But regardless of how new the credit report is, we have to do a credit update 7 days before closing to make sure you have not gone out and bought a new car, gotten any new loans, that kind of thing. It used to be the really trendy thing where you would drive the new car to the new house closing, and then the government said, hey, that new car loan, did we factor that into the equation when we were figuring out debt to income ratio? No, we did not. So now they require lenders to do a credit update within 7 days of closing to make sure you haven't gone out and done anything like that. Okay. Talk to your lender first. We will find out if you've gotten out and gotten any new loans. And it seems like obvious, like why would anybody do this? Well, to be fair, when you're under contract is exactly when you want to open up new accounts. Hey, I need to get new furniture, so I might want to, stop by American Furniture Warehouse. Or hey, it's almost President's Day, and they have a new washer and dryer available for purchase, and I might as well take advantage of the sale while I'm under contract. We will find out that Home Depot or Lowe's check your credit. We will have to find out if you've gotten any new accounts. Okay, so just talk to your lender, be upfront and honest. There's ways to get ahead of it if we need to. Okay. Do not make any unnecessary large purchases. We need your funds for closing, but more importantly is deposits. Okay, if you have any deposits in your bank account that are more than 50% of your typical pay, I have to find out where that money came from. And that's within that's within 2 months of you going under contract. So if you go under contract May 1st, I have to get April and March's bank statement. If there's any large deposits on those bank accounts, I have to find out where that money came from. Why? Again, all these loans are backed by the government in one way or another. And the government's really worried about money laundering. They're worried that you sold drugs. I joke you not. They're worried that you sold drugs and now you're using that drug money to buy a house. And now the government is lending you money, the drug kingpin over there, to go buy a house. That's quite literally what the government's worried about. So talk to us. There's typically another solution to problems that arise, but just be upfront and honest. We will find out about it. Just we're on your side. We want to get you into the house. We want to get you, have you become a homeowner. Just be upfront and honest with us. We can work around most problems if we know in advance. Please provide the documentation, W-2s, pay stubs, bank statements, all that as quickly as possible. We ask for it within 3 business days of closing, of going under contract. That's so we can keep you on schedule. Depending on your contract timeline, typical contract to closing is about 30 days. It's very common that's all the way down to 3 weeks right now because it's a little bit more of a seller's market. Sellers get demand more than they otherwise would be able to. So please provide us the documentation as quick as possible so we can get your file into underwriting. Speaking of which, when we get all that documentation, we're going to send your file to the underwriter. The underwriter's job is to make sure that the documents we provided meet their government's requirements for what they require. Okay. Make sure there's no large deposits. Make sure we have 2 months of bank statements. Make sure we have 2 years of W-2s. Make sure we have 30 days of pay stubs. Their job is to provide, make sure that what we've provided meets up all of that. Make sure our income calculations are right. Make sure there's nothing on fraud or anything like that that might have shown up. Okay. They're going to verify all the information, ensure it complies with the guidelines, and then they're going to issue what we call a conditional loan approval. Conditional loan approval means, hey, look, the loan's approved. Yay, conditional upon. Boo. They want to make sure that if we're missing a documentation, you have a chance to get us that documentation. You'll get us that additional documentation. We'll send your file back to underwriting, and then they will issue final loan approval. Okay, final loan approval, your loan is fully approved. Which brings us to closing itself. Okay, so for closing, you will physically go to the title company. Okay, your agent will sit on one side of the table with you. Title rep will sit at one end. I'll sit on the other end of the table. I try to go to as many closings as I can. Some lenders don't, but I'm really there more for moral support than anything. Answer any questions I possibly can for you. Title company rep is going to hand documentation back and forth, explain exactly what you're signing. Okay, you'll sign it. They will then notarize it, and then they'll record it with the county after closing. So the title company, the title closer, will handle the physical act of closing itself. Okay. I will review your closing disclosure with you prior to closing. Make sure you don't have any questions. Make sure you know exactly what you need to do. You'll either bring the funds in the form of a cashier's check or a wire to the title company. And then in Colorado, we call it the Wild Wild West. In Colorado, once you sign on the dotted line, you will receive keys to your house. You will turn over your money, and closing has occurred. We do not have what they call an escrow period in Colorado. Everything happens physically at the closing table. You sign on the dotted line, you get the keys, you turn over your check. It is official as of that day. It's very unique in Colorado. There is no additional waiting period after that. Once you sign the dotted line and you turn over your money and get the keys, you officially bought a home. Congratulations. That is it. That is it. That is the process from first inquiring, getting a mortgage, all the way through closing. That's the entire process. It sounds like a lot. It is, but your real estate agent and your lender will walk you through every single step. Every single step along the way, we will walk you through everything. So don't stress, baby steps, start with getting pre-approved. We'll work our way to a pre-approval. Then you can start to look at homes. Any questions, Allison?
We don't have any questions. Thank you so much, Aaron.
Of course, absolutely my pleasure. If anybody does have any questions, please let me know. Take a screenshot, grab my information. It probably comes off, I hope it does, but I love the education part of it. I really do. First-time home buyers are my favorite. If you have a question, I will love nothing more than answer that for you. So yeah, drop us a question if you have any.
Oh, quick, we do
Yeah.
have one question.
Is medical debt considered?
Yes.
So typically if it's a medical payment, we would count a medical payment. And that would be like you signed up for a firm or Sync Care, something like that, where you signed up for like a medical payment program at the medical office. They would that would probably show up on your credit report. If it's a medical collection, those typically do not need to be paid off as part of closing. Those would fall into the collections line. Medical collections are extremely common. Whenever you go to the doctor's office and you're like, hey, why do they ask me for my updated address every single freaking time? Well, it's because of medical collections. Those are so commonplace these days. So medical collections don't have to typically be paid off. If you are on a payment plan, that likely would show up. If it's not on a payment plan, but it's like directly through them and they don't report to the credit bureaus, we would not know about it. It's a great question. Beautiful. If anybody else has any other questions, please shoot me an email, drop me a call, give me a text, however I can help you. Thank you all so much, and I'll see you at the next one. Thanks.